Hey everyone, welcome back to Corporate Decoder, the place where we uncover the real story behind those thick financial reports. Today we're diving into a report for the Edgar Lomax Value Fund. And let me tell you, this one has some interesting performance figures that might just make you look twice at where your money is going. Alright, let's get into it. This filing is essentially a year-end report for the Edgar Lomax Value Fund, covering the period from the 1st of November 2024 to the 31st of October 2025. Imagine it as a big checkup for the fund, showing how it performed and what influenced its journey. First up, the what were the fund costs for the past year section. This is crucial because it tells us how much it costs you, the investor, to have your money managed. For the Edgar Lomax Value Fund, based on a hypothetical $10,000 investment, the cost came out to a neat $53. That's about 0.50% of your investment. It sounds small. But in the world of investing, even a sliver can add up over time. Now for the big question, how did the fund actually perform? For the year ending the 31st of October 2025, the fund saw a gain of 10.91%. That sounds pretty good, right? But here is where it gets interesting. The S&P 500 index, a common benchmark, returned a much higher 21.45%, and even the S&P 500 value index, which is supposed to be more in line with this fund strategy, returned 9.35%. So, while the Lomax fund grew, it lagged behind its peers and the broader market. The report points to a few key reasons for this. It talks about investors chasing growth stocks, especially big tech names like Nvidia, which made up a huge chunk of the S&P 500's gains. This trend, often called the risk-on trade, meant that value stocks, the kind Lomax tends to invest in, meaning companies that are undervalued with good dividends got left behind. The report highlights that value stocks, particularly those with higher dividend yields, like Lomax portfolio, underperform their growth counterparts. The fund proudly states their focus is on finding solid businesses, not just stocks that have performed well over long periods and are cheap because they are overlooked. They believe this traditional value approach offers future outperformance with less risk. Their portfolio's dividend yield is 3.14%. Significantly higher than the S&P 500's 1.15% and the S&P value's 1.89%. This high yield suggests they are indeed investing in more mature, dividend-paying companies. They believe this fundamental strength with stable earnings, modest debt, and good dividends will pay off, especially during future economic downturns. Looking at who helped the fund's performance, International Business Machines Corp, Citigroup Incorporated, and Goldman Sachs Group Incorporated are listed as top contributors. These are all well-established financial and tech companies. On the flip side, Dow Incorporated, United Health Group Incorporated, and Texas Instruments Incorporated were the biggest drags on performance. These are also solid companies, suggesting that even within the value space, some sectors or specific companies struggled more than others during this period. The report elaborates on the performance disparity, using the last quarter of 2025 as an example. While the S&P 500 jumped 8.23%, the Magnificent 7 tech giants alone contributed 4.70% of that gain, leaving the other 493 companies to make up the remaining 3.53%. The S&P 500 value index did grow by 6.45%, but the most value-heavy part of the index, the top 25% by dividend yield, only managed a tiny 0.09% gain. In this environment, the Edgar Lomax Value Fund still managed to gain 6.06% in that quarter. And importantly, it outperformed the S&P 500 value index over the entire 12-month period. Now let's look at the longer-term picture. The fund presents hypothetical investment growth. If you invested $10,000 in the fund, over 10 years it grew to $25,425. In comparison, the same $10,000 in the S&P 500 would have grown to $39,196 and in the S&P 500 value to $29,364. This shows that over a decade, while Lomax provided growth, the S&P 500 significantly outperformed, and even the S&P 500 value had a stronger showing. Digging into the annual average returns, over 1 year the Lomax fund returned 10.91%, the S&P 500 returned 21.45%, and the S&P 500 value returned 9.35%. Over 5 years, Lomax returned 14.30%, S&P 500 returned 17.64%, and S&P 500 value returned 16.06%. And over 10 years, it is 9.78% for Lomax, 14.64% for S&P 500, and 11.37% for S&P 500 value. The trend is clear. Lomax has consistently underperformed the broader S&P 500, and in most cases the S&P 500 value index as well, especially in recent years. Let's look at some key statistics for the fund as of the 31st of October 2025. Net assets are just under $99.6 million. The number of holdings is 53. The net advisory fee, which is what the fund manager gets paid, is about $38,554, and the portfolio turnover rate, meaning how often they buy and sell investments, is at a relatively low 35%. This low turnover aligns with their stated value investing strategy, which often involves holding companies for longer periods. What exactly are they investing in? The top 10 issuers, meaning the biggest companies in their portfolio, include many familiar names. CVS Health Corporation is their largest holding at 5.5%, followed by Johnson & Johnson at 4.9%, and International Business Machines Corporation at 4.2%. Other notable holdings include Verizon Communications Incorporated, Merck & Company Incorporated, Coca-Cola Company, and Citigroup Incorporated. This confirms their focus on large-cap established companies. Sector-wise, their largest allocation is to manufacturing at 44.7%. This is quite a chunk, likely reflecting companies that produce goods. Finance and insurance is next at 17.9%, followed by retail trade at 8.4% and information at 8.3%. This sector breakdown further solidifies their strategy of investing in established industries. Now we're looking at the core financial statements. The statement of assets and liabilities shows the fund's financial position on the 31st of October 2025. Investments in securities are valued at almost $99.5 million with an identified cost of just over $85.7 million. This means the current market value is higher than what they paid for these investments, which is a good sign. Liabilities are relatively small, around $140,000. The net assets of the fund stand at $99,599,830. The net asset value per S-share, which is the price of one share of the fund, is $16.45. This is calculated by taking the net assets and dividing by the number of shares outstanding, which is about 6.06 million. Looking at the statement of operations for the year ended the 31st of October 2025, the fund generated about $3.2 million in investment income, primarily from dividends. Expenses are also listed, with advisory fees being the largest chunk at over $525,000. However, there is a note about an advisory fee waiver, which brought down the net expenses significantly. This advisory fee waiver is quite interesting. The advisor agreed to waive a portion of their fees to keep total annual fund operating expenses around 0.50% if the fund underperforms benchmarks. For this year, they voluntarily waived a substantial amount, reducing the net advisory fees and ultimately benefiting the shareholders. This is a positive step, showing the advisor is aligning their interests with investors, especially when performance is lagging. The net increase in net assets from operations for the year was about $10 million. This is a healthy increase and shows the fund is generating more value than it is spending. When we compare this year to the previous one, the net increase in net assets from operations was much higher in 2024, over $21 million. This indicates that while 2025 was a positive year, 2024 saw even stronger growth, likely driven by market conditions that favored value investing more. The financial highlights table gives us a quick snapshot of key metrics over several years. The total return for the year ended the 31st of October 2025 was 10.91%, matching what we saw earlier. The ratio of expenses to average net assets after waivers is a consistent 0.50%, which is a testament to their cost control and fee management. The portfolio turnover rate has also remained relatively steady. Looking at the net asset value per S-share over the years, we see it at $15.73 at the start of 2025, rising to $16.45 by the end. In 2023, it was $13.06, and in 2024, it was $14.58. The 2025 performance of 10.91% is solid, but notice the massive 43.39% return in 21, highlighting how market conditions can dramatically impact returns, especially for specific investment styles. This section explains that the Edgar Lomax Value Fund is a series of advisors series trust and follows standard accounting principles. It also states the fund's objective is long-term capital growth with some income, which it has been pursuing since 1997. Here, they detail their accounting practices. Investments are valued at fair value. They aim to comply with tax regulations by distributing earnings, and transactions are recorded on the trade date. It's standard stuff for a fund, but crucial for transparency. This note is about how they determine the fair value of their investments. They use a 3-level hierarchy. Level 1 is for readily available market prices, Level 2 for observable inputs, and Level 3 for unobservable ones. For this fund, all their common stocks, real estate investment trusts, and money market funds are valued at Level 1. meaning they are actively traded and have clear market prices. This simplifies things and suggests no heavily illiquid or hard-to-value assets. This is where the fee waiver we touched on earlier is detailed. The advisor's fee is 0.55% annually, but they've agreed to cut it to keep total expenses at 0.50% if the fund underperforms certain benchmarks over 3 or 5 years. This year alone, they voluntarily waived about $47,000 in advisory fees and absorbed other expenses to keep costs down, which is great for shareholders. The report also notes that some of these fee reductions might be recaptured in future years if certain conditions are met, but without exceeding expense limits at that time. This section outlines the buying and selling of securities. For the year, they purchased over $32 million worth and sold over $35 million worth, excluding short-term investments. This is consistent with their stated portfolio turnover rate, indicating a managed approach to portfolio adjustments. Here, they break down the tax character of distributions paid out. For 2025, it was over $5.1 million in ordinary income, and about $342,000 in long-term capital gains. The report also shows the tax basis components of accumulated earnings, indicating a healthy surplus. This note mentions that the Edgar Lomax company owns 30.37% of the fund's outstanding shares. This ownership stake is significant and generally considered to create a presumption of control under the 1940 Act, meaning the advisor has substantial influence over the fund's operations. This is the auditor's report, in this case from Tate Weller and Baker LLP. They state that in their opinion, the financial statements present fairly the fund's financial position. They conducted their audits following standards set by the Public Company Accounting Oversight Board, confirming that the financial reporting is in line with generally accepted accounting principles in the United States. Now, let's talk about my take on all of this. The Edgar Lomax Value Fund, as its name suggests, is firmly planted in the value investing camp. Their strategy of focusing on fundamentally sound, often overlooked companies with solid dividend yields makes sense, especially in volatile times. The fact that they are proactively waiving fees when they underperform their benchmarks is a big plus, showing a commitment to shareholder value. Their low portfolio turnover and straightforward valuation of assets at level 1 also suggest a disciplined and transparent approach. However, the glaring issue here is performance relative to market benchmarks. While the fund did have a positive year and outperformed the S&P 500 value index, it significantly lagged the broader S&P 500. Over the long haul, the numbers show a consistent underperformance against both general market indices and their specific value benchmark over the last decade. This raises a question: is the fund's niche strategy, while sound in principle, currently suited for the prevailing market winds? The dominance of growth stocks, particularly in tech, has created a strong tailwind for broader market indices that value-focused funds have struggled to consistently capture. The opportunity lies in the potential for a market shift. If growth stocks cool off, or if an economic downturn makes defensive dividend paying value stocks more attractive, Lomax could shine. The risk, however, is that this trend of growth outperformance continues, leaving value funds like Lomax playing catch-up for an extended period. In conclusion, Edgar Lomax Value Fund appears to be a well-managed, cost-conscious fund with a clear and consistent strategy. Its strengths lie in its disciplined approach and shareholder-friendly fee structure, but potential investors should be aware of its recent performance history and understand that its success is heavily dependent on market conditions favoring value over growth. If you believe a rotation back to value is imminent, this fund might be worth a look. Otherwise, you might find broader market index funds delivering stronger returns in the current environment. Alright, that is our breakdown of the Edgar Lomax Value Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Are you a value investor? Let me know in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate documents. Don't forget to check out our Discord community linked in the description for more discussions and insights. Thanks for watching. See you next time.